This is the hardest video I have ever had to make. For years, I have been analyzing the silver market and sharing my predictions with you. I have built this channel on the promise of honest, rigorous analysis, and today I have to admit something that is painful to say out loud. I was wrong. I made a significant mistake in my silver analysis, and that mistake may have cost some of you money. I believe in accountability. I believe that when you build trust with an audience, you owe them honesty even when that honesty is uncomfortable. Especially when it is uncomfortable. Anyone can take credit when they are right. The measure of an analyst is whether they can admit when they are wrong. So today, I'm going to tell you exactly where I went wrong, what I should have seen that I missed, what lessons I learned from this mistake, and how I am adjusting my approach going forward. This is my confession, this is my accountability, and I hope that by sharing my mistake openly, I can help you avoid making the same error. Subscribe to John A.G. Alert right now if you have not already. Hit the notification bell, like this video, because honest content like this needs visibility. Drop a comment telling me whether you have made similar mistakes. Share this with anyone who needs to hear an analyst admit they were wrong for once. Let me take you back to where my mistake began. Several weeks ago, I was extremely bullish on silver in the short term. I saw the supply deficit growing. I saw industrial demand exploding. I saw physical premiums rising. I saw inventory drawdowns at COMEX. Every fundamental indicator was flashing green. Based on this analysis, I suggested that silver was ready to move significantly higher in the near term. I talked about imminent breakouts. I talked about prices ready to explode. I was confident, perhaps too confident. What happened next? Silver crashed 31% in a single day. The worst single session in 46 years. Billions of dollars in long positions were liquidated. Investors who followed bullish analysis, including mine, saw their accounts devastated. Now, I want to be clear about something. I've always advocated for physical silver held long-term without leverage. Investors who followed that core advice are fine. They still have their metal. Prices have rebounded significantly. The long-term thesis remains intact, but some viewers may have been more aggressive based on bullish sentiment. Some may have bought leveraged products. Some may have concentrated their purchases at exactly the wrong time, and my bullish tone may have contributed to those decisions. That is my responsibility. That is what I got wrong, and I need to own it. Let me explain specifically what I missed, because understanding my error helps you become a better investor. Mistake number 1, underestimating exchange intervention. The single biggest thing I missed was the willingness of exchanges to intervene with extreme margin increases during volatile periods. I knew manipulation existed. I've talked about it extensively on this channel, but I underestimated how aggressive that intervention would be. A 37% margin increase in a single announcement was beyond what I thought they would do. It was designed to cause maximum damage to leveraged long positions, and it worked. I should have anticipated this. The signs were there. Volatility was increasing, open interest was elevated, the rally was attracting attention. These are exactly the conditions that historically precede exchange interventions. I should have warned more strongly about this risk. Instead, I was focused on the bullish fundamentals. Supply deficit, industrial demand, physical tightness, these factors are real. They remain bullish for the long term, but in the short term, they can be overwhelmed by coordinated interventions. I did not give enough weight to this possibility. The history of precious metals markets is filled with examples of sudden rule changes and margin adjustments that caught traders off guard. When I look back at similar situations in 2011, in 2016, and in 2020, the pattern was clear. Yet I failed to apply those historical lessons to the current situation. This was not just an oversight. It was a failure of pattern recognition that I should have caught. Mistake number 2, ignoring cross-asset correlations. My second mistake was underestimating the correlation between silver and broader market stress. When the trillion-dollar tech crash hit, it created margin calls across the entire financial system. Investors who were long tech stocks and long silver faced pressure on both positions. They sold silver to meet margin calls on tech. They sold silver because they needed liquidity. This cross-asset correlation is something I understood intellectually, but did not emphasize enough in my analysis. Silver does not trade in isolation. It is connected to global liquidity conditions. When liquidity tightens across the system, silver faces selling pressure regardless of its specific fundamentals. I should have been watching broader market stress more carefully. I should have warned that a stock market crash could spill over into precious metals. I should have connected those dots more clearly for you. The interconnected nature of modern financial markets means that no asset is truly isolated. When hedge funds face redemptions, When banks tighten lending standards, when margin clerks make their calls, the selling pressure spreads like wildfire across asset classes. Silver, being a relatively smaller market compared to stocks or bonds, often gets hit disproportionately hard during these liquidity crunches. I understood this mechanism, but I failed to weight it properly in my analysis. Mistake number 3, timing conviction. My third mistake was timing conviction. I was right about the direction. Silver is going higher over the long term. The fundamentals support dramatically higher prices, but I was too precise about timing. I suggested imminent moves when I should have been more humble about short-term unpredictability. The truth is that nobody knows exactly when silver will break out. Nobody knows whether the next move is up or down in the short term. Expressing high conviction about timing was an error. The fundamentals tell you direction. They do not tell you timing. I should have been clearer that my bullish view was about months and years, not days and weeks. I should have emphasized more strongly that short-term volatility is unpredictable even when long-term direction is clear. There is a dangerous trap that analysts fall into where pattern recognition creates false confidence. Because I had successfully identified previous turning points, I began to believe I could consistently time short-term moves. This is a cognitive bias that I should have recognized and guarded against. The market has a way of humbling those who become too certain about short-term price action. Mistake number 4, insufficient leverage warnings. My fourth mistake was not warning strongly enough about leverage risk. I've always said that leverage is dangerous in silver, but perhaps I did not say it loudly enough or often enough. Perhaps my bullish tone created an impression that the risks were lower than they actually were. The investors who got destroyed in the crash were almost entirely leveraged traders. They were using futures with margin. They were buying leveraged ETFs. They were using options with short expirations. These instruments magnify losses just as they magnify gains. When silver dropped 31%, a 3x leveraged product dropped over 90%. Some accounts were completely wiped out. These were not irresponsible gamblers. Many were investors who believed in the silver thesis and wanted exposure. They just chose the wrong vehicle. I should have warned about leverage in every single video. I should have made it the first thing I said and the last thing I said. I should have been relentless about this risk even when it seemed repetitive. Looking back at my content, I can see that my leverage warnings were there, but they were buried in the middle of videos, mentioned briefly, not given the emphasis they deserved. When someone is excited about a bullish thesis, they tend to minimize risk warnings in their mind. As the presenter, I needed to compensate for that psychological tendency by making my warnings impossible to ignore. Mistake number 5, inadequate emotional preparation. My fifth mistake was not preparing you adequately for the emotional reality of crashes. I talked about volatility intellectually. I mentioned that silver could swing sharply, but I did not prepare you emotionally for what a 31% crash actually feels like. Watching your investment lose a third of its value in hours is traumatic. Even if you believe in the long-term thesis, the pain is real, the fear is real, the temptation to sell at the bottom is overwhelming. Knowing intellectually that you should hold is different from actually holding when your account is bleeding. I should have done more to prepare you for this experience. I should have talked about what crashes feel like, not just what causes them. I should have helped you build the psychological framework for holding through extreme volatility. I should have shared stories of previous crashes and how investors felt during them. I should have discussed the specific emotions that arise, the panic, the doubt, the questioning of everything you thought you knew. The gap between intellectual understanding and emotional resilience is vast. It's the difference between reading about a roller coaster and actually riding one. I gave you the intellectual framework, but failed to adequately prepare you for the emotional ride. Now let me tell you what I learned from this mistake, because errors are only valuable if you extract lessons from them. Lesson number 1, direction versus timing. The first lesson is that timing is much harder than direction. Getting the long-term direction right is valuable, but expressing conviction about short-term timing is dangerous. Going forward, I will be more humble about when moves will occur. I will focus on positioning for eventual moves rather than predicting imminent breakouts. This distinction is crucial. Many analysts are correct about where an asset is heading, but lose credibility by being wrong about when it will get there. The fundamentals can be perfect, the analysis can be sound, but if the timing prediction is off by months or years, investors can lose money or lose patience. I need to clearly separate these two aspects of analysis. Lesson number 2, price and manipulation risk. The second lesson is that manipulation risk must be priced into every analysis. The exchanges, the banks, the regulators, they have tools to move prices in the short term. Margin increases, rule changes, coordinated selling. These interventions can overwhelm fundamentals temporarily. I will give more weight to intervention risk going forward. This means developing a framework for assessing manipulation probability. When is open interest too high? When has a rally attracted too much attention? When are the manipulators most likely to strike? These are questions I need to systematically address in my analysis, rather than treating manipulation as an abstract concept. Lesson number 3, monitor cross-asset dynamics. The third lesson is that cross-asset correlations matter during stress events. Silver does not exist in a vacuum. It is connected to stocks, bonds, currencies, and global liquidity. During market stress, these correlations intensify. I will watch broader market conditions more carefully and warn when spillover risk is elevated. This requires expanding my analytical framework beyond silver-specific factors. I need to monitor stock market valuations, bond market stress indicators, dollar strength, and global liquidity conditions. When these factors align in concerning ways, I need to warn about potential spillover effects, even if silver fundamentals look strong. Lesson number 4, constant leverage warnings. The fourth lesson is that leverage warnings need to be constant and emphatic. Once is not enough. Mentioning it occasionally is not enough. Every video should include explicit warnings about leverage risk. This channel should never leave any ambiguity about the dangers of leveraged silver products. I'm committing to making leverage warnings a standard part of every video structure, beginning, middle, and end. Repetitive, perhaps, but necessary. The cost of someone misunderstanding the leverage risk is too high to worry about being repetitive. Lesson number 5, build psychological resilience. The fifth lesson is that emotional preparation matters as much as analytical preparation. Understanding why you should hold through a crash is not the same as being able to actually do it. I will spend more time helping you build psychological resilience for volatility. This means discussing mental frameworks, sharing historical examples of how previous crashes felt, and providing practical techniques for managing emotions during market stress. It means preparing you not just for what might happen, but for how it will feel when it does. Now let me tell you how I am adjusting my approach going forward, because lessons without changes are meaningless. Change number 1. Clear time frame, separation. First, I will separate my short-term tactical views from my long-term fundamental views more clearly. When I say silver is going higher, I will be explicit about whether I mean next week or next year. I will avoid implying near-term certainty when I only have long-term conviction. This means structuring my analysis with explicit timeframes. Over the next 3-5 years, I expect silver to reach X based on Y fundamentals. However, in the next 3 to 6 months, volatility could drive prices in either direction, and short-term predictions are unreliable. This kind of clarity will help you understand exactly what level of conviction I have at different timescales. Change number 2, systematic manipulation assessment. Second, I will include manipulation risk assessment in every analysis before expressing bullish views. I will explicitly consider what tools the manipulators have and how likely they are to use them. I will warn about elevated intervention risk when conditions suggest it is likely. I'm developing a manipulation risk scorecard that evaluates factors like open interest levels, rally intensity, media attention, and historical patterns. When this scorecard shows elevated risk, I will prominently feature that warning regardless of how bullish the fundamentals appear. Change number 3, broader market monitoring. Third, I will monitor broader market conditions more systematically. I will watch the stock market, the dollar, interest rates, and liquidity indicators. I will warn when these factors create spillover risk for silver, regardless of silver-specific fundamentals. This requires adding sections to my analysis focused on macro conditions. Even if a video is primarily about silver, I need to contextualize that analysis within the broader market environment. When stock market valuations are extreme, when credit markets show stress, when liquidity conditions are tightening, these factors need to be part of every silver analysis. Change number 4, prominent leverage warnings. Fourth, I will make leverage warnings more prominent and more frequent. I will start videos with leverage warnings. I will end videos with leverage warnings. I will make sure no viewer can miss the message that leveraged silver products are extremely risky. I'm creating a standard disclaimer that will appear in every video, both as spoken words and as on-screen text. Something like, warning, leveraged silver products including futures, leveraged ETFs, and options are extremely risky and can result in total loss of capital. This channel recommends physical silver held without leverage for long-term investment only. Change number 5, emotional and psychological focus. Fifth, I will spend more time on the emotional and psychological aspects of silver investing. Not just what to do, but how to actually do it when your account is crashing. practical techniques for managing fear and maintaining conviction. This means dedicating specific content to psychological preparation, videos on how to handle drawdowns, how to avoid panic selling, how to maintain long-term perspective during short-term chaos, sharing not just analytical frameworks but emotional coping strategies. Now let me address something important. Despite my mistake, I want to be clear that my long-term view on silver has not changed. The supply deficit is real. Industrial demand is growing. Physical shortage is worsening. Policy is turning bullish. Chinese export restrictions are tightening supply. All of the fundamental factors that made me bullish before the crash remain in place. The crash did not change the fundamentals. It changed the price temporarily, but it did not create new silver supply. It did not reduce industrial demand. It did not reverse the deficit. Investors who held physical silver through the crash still have their metal. Prices have rebounded significantly from the lows. The long-term thesis is intact. My mistake was about timing and risk warnings, not about the underlying analysis. I was wrong about when and how the move would happen. I was not wrong about the direction. This is an important distinction. When an analyst is wrong about fundamentals, you should stop listening to them. When an analyst is wrong about timing, you should adjust your expectations about their ability to predict short-term moves. These are different types of errors. The supply deficit in silver is not a matter of opinion. It's documented by industry data. The growth in solar panel production, electric vehicle adoption, and 5G infrastructure is measurable and ongoing. The drawdown in COMEX inventories is publicly reported. These fundamental factors have not changed. What changed was my ability to predict when these fundamentals would translate into price action. I'm not asking you to ignore my mistake. I'm asking you to categorize it correctly. My fundamental analysis remains sound. My short-term timing predictions proved unreliable. Weight my work accordingly. Let me also address those of you who lost money during the crash. I'm genuinely sorry if my analysis contributed to your losses. That is not an easy thing to say, but it is the truth. Analysts have influence. With influence comes responsibility. When people lose money, even if their losses resulted from their own decisions, I feel some responsibility for the environment I helped create. If you lost money on leveraged silver positions, I hope you can recover. I hope the lessons you learned will make you a better investor going forward. I hope you have not lost faith in silver as a long-term investment just because of a short-term manipulation event. The investors who did best during the crash were those who owned physical silver without leverage. They did not get margin calls. They did not get stopped out. They did not have expiring options. They just held their metal and waited. The crash came and went. Their position remained intact. This is why I emphasize physical silver so consistently. Not because I am paid by dealers, not because I have some agenda, but because physical silver is the only form of silver investment that protects you from the exact kind of manipulation we just witnessed. Paper silver, leverage products, futures contracts, all of these can be attacked through margin increases and rule changes. Physical silver cannot. It sits in your safe regardless of what COMEX does. If my mistake teaches you anything, I hope it teaches you this. Own physical, hold without leverage, think long-term, ignore short-term volatility. Now let me tell you what I expect going forward. Because despite my mistake, I still have views worth sharing. I expect continued volatility. The forces that created the crash are still present. The exchanges can raise margins again. The banks can coordinate selling again. Short-term manipulation remains a risk. I expect the fundamental factors to eventually overwhelm the manipulation. Physical shortage cannot be faked forever. Industrial demand cannot be denied forever. At some point, paper prices must reflect physical reality. I expect this process to take longer and be more volatile than I previously suggested. I was too aggressive about timing before. I will be more patient going forward. I expect that investors who hold physical silver through this period will be rewarded. The destination is higher prices. The path is uncertain and volatile. I expect to make more mistakes in the future because I am human and markets are unpredictable. When I do, I will admit them, just as I am admitting this one. That is my commitment to you. The silver market is uniquely challenging to analyze because it sits at the intersection of industrial commodity, monetary metal, and manipulated market. These three aspects often point in different directions in the short term. The industrial fundamentals are bullish, the monetary demand is growing, but the manipulation keeps prices suppressed. Eventually, physical reality wins, but predicting exactly when requires more humility than I previously demonstrated. Before I close, I want to thank those of you who have sent supportive messages even after the crash. You understood that one bad call does not invalidate years of analysis. You extended grace that I'm not sure I deserved. I appreciate you more than you know. I also want to thank those of you who sent critical messages. You held me accountable. You push back when I was wrong. That is what an honest community looks like. I would rather have critics who make me better than fans who let me stay complacent. Building a community around financial analysis is about more than just making predictions. It's about creating an environment where honest discussion can happen, where mistakes can be acknowledged, where learning is continuous. Some of my best insights have come from viewer comments challenging my assumptions. That dialogue makes this channel better. John AG Alert exists to provide honest silver analysis. Sometimes honest means admitting mistakes. Today was that day. Subscribe if you value honesty over ego. Hit the notification bell for future updates. Like this video because accountability deserves visibility. Drop a comment telling me about your own investing mistakes. We all have them. Sharing them makes us all better. The financial analysis industry has a credibility problem. Too many analysts never admit mistakes. They quietly forget their wrong predictions and only highlight their successes. This creates a distorted picture that damages investor trust and leads to poor decision-making. By being transparent about errors, we can build a more honest discourse around investing. Every investor makes mistakes. Every analyst gets calls wrong. The question is whether we learn from those mistakes and adjust our approach. That's what separates growth from stagnation. I made a significant error in my silver timing. I owned it. I analyzed it. I extracted lessons. And I'm implementing changes to do better going forward. I was wrong about silver timing. I own that mistake. I am learning from it. I'm adjusting my approach, and I am coming back with better analysis going forward. The journey of market analysis is one of continuous improvement. No analyst is perfect. The best we can do is be honest about our limitations, learn from our errors, and constantly refine our approach. That's what I'm committed to doing. Silver remains one of the most compelling long-term investments in my view. The fundamental case has not changed. What has changed is my humility about short-term timing and my commitment to better risk communication. I will continue providing the analysis you've come to expect, but with clearer timeframes, more prominent risk warnings, and greater attention to the emotional aspects of volatile markets. Thank you for being part of this community. Thank you for holding me accountable. Thank you for continuing to engage even when things didn't go as predicted. Your support and your criticism both make this channel better. This is John AG Alert. Thank you for sticking with me through the hard stuff. I will see you in the next video.